So there's a couple of strategies. I'm not going to go into this in depth tonight, but if you have a large taxable component in your super fund and you're under 65, you can undertake a recontribution strategy to try and reduce the amount of taxable component in your fund. And that's just where, if you're, say you're aged 60 and you're now retired from working, you can pull money out of super tax-free because you're over 60, and then you can recontribute the money back into super as a non-concessional contribution. So you're just, in effect, turning it from taxable component and back into tax-free component. Now, the tax office is aware that advisors and accountants advise their clients to do this, and they've put out several strategy papers which say that that strategy is not tax avoidance, because you are trying to maximise benefits for your beneficiaries, and again that goes back to the sole purpose test. So that's a strategy that can be undertaken. The other strategy that I wanted to probably talk about a little bit more in depth, because a lot of people are not aware of this as a strategy. So back in June '88, so I was talking about Bjelke-Petersen being the state premier, but at the time Keating was the Treasurer of Australia, and prior to 30 June 1988, there was no contributions tax on super in Australia, and therefore there was also no death tax on the way out of super. So unfortunately, 1 July '88, Keating government brought in contributions tax on super, the 15%. And at that time, they brought in another piece of legislation which is really fair, which says that if you're now paying contributions tax, they don't want your beneficiaries to be disadvantaged or to get less in the estate because of all the contributions tax you've paid during your lifetime. So it's called an anti-detriment payment, which just means we don't want there to be a detriment because of the contributions tax. So retail super funds can do this, and some do and some don't. In a self-managed super fund, to make an anti-detriment payment, which is in effect a refund of the contributions tax that had been paid in that person's lifetime, you have to have a reserve account. And I remember a few years ago I was talking to someone about this, and they were saying this is a fantastic strategy, and I said, yeah, but you have to die to get it, so just keep that in mind. But you have to be able to do this, you have to have a reserve account in your super fund, and it has to be already in place when you pass away. So if we've created a reserve account, we need to have enough money held in reserve in that account to pay the refund of the contributions tax. And when you have a look on your self-managed super fund financials, you'll see that the money is broken up into, your member balance and your spouse's member balance. If you see on there another line that says reserve account, it means you've got one of these things. If you don't, you haven't. But you can create a reserve account. So if I had someone that needed a reserve account of $163,000. So if you know how much contributions tax you've paid every year, if you've got the records going back to when you started work, you can just go through and add it up every year and come up with the figure. We usually find that's not the case, so we just use a formula that's set out in the Tax Act to calculate how much that would be. So in this case, I've just come up with a figure of $163,000. That's if someone started working back in the in the late 80s and has been contributing a fair bit into super since then. It's not unusual. So when the last spouse passes away from our fund, the fund is going to pay out the $163,000 out of the reserve account to the beneficiaries. Okay. Now at that point, no one's really got anything extra then, because had there not been a reserve account, the money would have been all part of the pool anyway. But it pays the money out to the estate, but it then has made that payment on the tax office's behalf. So it's made the payment, it then does its tax return for the year and says to the tax office, I've made this payment out on your behalf, can you please now give me the money back? Okay? And it claims that money back by claiming a tax deduction of the amount grossed up by 15%. So in this case, $163,000 divided by 15% is $1,083,000. So the fund then gets to claim a massive tax deduction of $1,083,000 in that year. Now, if we go back to someone that has a large capital gain because they've had to sell a property in the fund to pay out the death benefit to the beneficiaries. So going back to my example, I had about a $536,000 taxable gain in the fund. This big tax deduction has now wiped that gain out completely. So we now don't have any capital gains tax issues in the fund. We also then have a $552,000 unused tax deduction sitting in that fund. And I think one of the things that people get a little confused about is they think that when they die, their super fund dies as well. And if we remember, the super fund is just a trust. So if you die, the super fund doesn't die, it's still in existence and it can carry on. So in this case, we've got this fund, it doesn't have any assets left in it, they've all been paid out to the estate, but it does have a big $500,000 unused tax deduction sitting in there, so, which could be quite valuable. So in this case, these people's 3 children, Tom, Bob and Joanne, all decide to come in as members of the super fund. They put their contributions into that fund in future, and in this case they could each contribute $25,000 a year for the next nearly 7.5 years and pay no contributions tax until that big tax deduction has been used up each year. So super funds can be multi-generational. They don't have to finish when you pass away.